Hi, I'm Jonathan Wild, and we cover how to prepare a classified balance sheet. A classified balance sheet is basically a balance sheet that groups your assets and liabilities into smaller categories or subgroups. For example, we might break down assets into current and non-current assets. Current assets are assets we expect to convert to cash or use up within 1 year or the operating cycle, whichever is longer. An operating cycle is the amount of time between when cash is used to purchase products or services to when cash is collected from the sale of products or services. For most companies, the operating cycle is less than 1 year. So we'll just use 1 year for the rest of this segment. Our example of current assets includes cash, accounts receivable, supplies, and prepaid rent, but could also include inventory and prepaid insurance. Now, non-current assets are assets we expect to hold for more than 1 year and are often broken down into 3 subcategories: long-term investments, plant assets, and intangible assets. Long-term investments are assets like long-term notes receivable due in 5 years, and stock investments we plan to hold for 3 years. If we were only planning to hold these for like 2 months, then they would be in current assets. Next, plant assets, or property, plant, and equipment, are assets with a long useful life and are currently being used in the company's operations. In our example, this includes machinery with accumulated depreciation and land, but could also include buildings and equipment. Next, intangible assets are assets that do not have physical substance, but are still valuable to a company's operations and are expected to generate future benefits. Our example includes patents and copyrights, but could also include trademarks and franchises. On a classified balance sheet, we give a total for each subcategory and then also calculate total assets. Companies also break down liabilities into current liabilities and long-term liabilities. Current liabilities are liabilities we expect to pay or settle within 1 year or the company's operating cycle, whichever is longer. Our example includes accounts payable, salaries payable, interest payable, and unearned services revenue, but could also include wages payable and income taxes payable. Next, long-term liabilities are liabilities we expect to pay for in more than 1 year from now. Our example includes notes payable due in 8 years, but could also include mortgages payable, lease liabilities, pension liabilities, and bonds payable. Remember though, that these liabilities can become current liabilities once they are due within 1 year. So always make sure to check when something is to be received or paid, as this determines if it is a current or long-term account. After liabilities, we report equity. Equity for a corporation includes common stock and retained earnings. On a classified balance sheet, we give a total for each subcategory and then calculate total liabilities. After that, we can add total liabilities to total equity to get total liabilities and equity. And just as another reminder, total assets must always equal total liabilities plus equity.